Today, we're diving into a crisis that's quietly brewing in the U.S. auto loan market. And honestly, the numbers we're seeing suggest the impact could be even bigger than the 2008 financial meltdown.
So let me just ask you this. What if something even worse than the 2008 financial crisis is already happening, right now, right under our noses? It's a heavy question, I know, but the data demands we ask it. It all starts with this one number, 6.56%. Now, I know, it probably just looks like another random statistic, but trust me, by the time we're done here, you'll see why this single figure is sending some serious shockwaves through the financial world.
And no, we're not talking about mortgages. This isn't a repeat of the housing crisis. This time, the problem is sitting right in our driveways. It's all about the auto loan market.
All right, so let's dig into what that 6.56% really means, because this is where the story goes from just being a little concerning to genuinely alarming. Okay, just take a look at this chart. It lays the whole story out crystal clear. This shows the percentage of subprime auto loan borrowers, so folks with lower credit scores, who are more than 60 days late on their payments. That 6.56% today, it doesn't just squeak past the 2008 peak, it completely blows past it. It's even higher than the market collapse way back in the late 90s. We are literally in uncharted waters here.
And to really get why this is such a huge deal, you gotta understand this scale we're talking about. The total U.S. auto loan market is a staggering $1.66 trillion. Now the subprime slice of that, loans to people with credit scores under 600, that's where the fire is starting. It's the most vulnerable piece of this giant financial puzzle. So the big question is, how on earth did we get here? Well, it wasn't just one thing. It was a combination of a whole bunch of factors that created a total perfect storm for the American consumer.
The numbers here are just wild. Since 2020, the average price of a new car has shot up over 20%. Used cars, they've exploded by 34%. Throw in soaring interest rates, and the average monthly car payment has jumped by $275. That is a massive, massive burden for most households, especially when wages haven't come close to keeping up.
And here's the real kicker. During the pandemic, you would have thought lenders would tighten up, right? Nope. They actually loosened their standards. The rejection rate for car loans actually fell, which means they were handing out credit to more and more people who, in normal times, might not have qualified.
Okay, so this is where it all starts to feel dangerously familiar. We're going to look at Wall Street's financial machine, and you'll see exactly why so many people are having serious 2008 flashbacks.
You have to understand this one key term, asset-backed security, or ABS. It sounds super complicated, but the idea is actually pretty simple. It's when Wall Street takes thousands of individual loans, bundles them all together, and then sells little slices of that bundle to big investors.
Think of it like a financial assembly line. Step 1, they scoop up thousands of these high-risk, subprime car loans. Step 2, they package them into these really complex bonds. And Step 3, they sell those bonds off to huge institutional investors, like pension funds, the places that manage retirement money for millions of people. If that sounds familiar, it's because it's the exact same playbook from the 2008 housing crisis.
And we're not talking about small change here. The total market for these auto loan securities has ballooned to over $282 billion. And that's how a problem with individual car payments can suddenly spread risk through the entire financial system.
But listen, this isn't just some theoretical risk we're talking about. This isn't a what-if scenario. The consequences are already hitting the real world. The dominoes have absolutely started to fall.
Just look at the timeline from this past year. In February, American Car Center went bankrupt, closing 40 stores. In April, U.S. auto sales shut down. And then the huge shocker in September, Tricolor Holdings just collapsed, almost overnight, dragging huge names like JPMorgan Chase into a mess filled with fraud investigations. These aren't just cracks in the foundation. The walls are starting to crumble.
And beyond all the corporate failures, there's a devastating human cost. In 2024, 17.3 million vehicles were repossessed. That's the highest number since the Great Recession. That's millions of families losing their main way to get to work, to school, to the doctor. The crisis is hitting military members and minority communities the hardest. And some lenders are using these predatory tactics, like putting GPS trackers and remote kill switches on cars to disable the engine if a payment is even a little bit late. It's just brutal.
So where does this all go from here?
Unsurprisingly, the experts are deeply divided on this. They basically see two very, very different futures ahead of us.
On one side, you've got the optimists. They're saying, hey, this is just a temporary correction. They think the Fed will cut interest rates, which will help people manage their payments. The worst lenders are already going out of business, which is actually good for the market. Plus, people with good credit are still paying their loans just fine. But then, you have the pessimists. They see a structural collapse on the horizon. Why? Well, unlike a house, a car loses value incredibly fast. So many borrowers are underwater, owing more than the car is even worth. And for them, the fact that people are defaulting on their car, the one thing they absolutely need to earn a living, is a terrifying sign that their finances have hit a brick wall.
A recent analysis from the Wall Street Journal really captured the heart of this debate. They said subprime is always subprime, but this time the scale and ripple effects are incomparably larger. The point is, while these loans are always risky by definition, the sheer size of the market this time around means the potential fallout is bigger than anything we've seen before.
So let's just recap the key takeaways here. Subprime auto delinquencies are at a 30-year high, worse than in 2008. Millions of cars were repossessed last year. Hundreds of billions of dollars in risk have been packaged up and sold across the entire financial system. And the huge, unanswered question is this a problem that's going to stay contained, or is this the first tremor of a much larger earthquake?
And that leaves us with a final, broader question to think about. In an age where we're all so focused on incredible new technology, AI, self-driving cars, what does it say about our economy when millions of people are losing the one basic tool they need just to participate in it?
That's our breakdown for today. Thanks so much for watching.